I love this part. It's probably one of my top favorite areas in finance. So here we're going to build your investment strategy. We're going to optimize your rate of return. But personal finance is personal because while mathematically it's true, investment strategies will yield different returns. But that's only if they are followed. And techniques that, might work for LeBron James in basketball, they won't work for most of us, right? He just says, just dunk. It's easy, just dunk, just throw a three-pointer. Like, okay, fine, well, I'm not that tall, I can't dunk, right? Instead of your vertical jump height, here it's emotional control. And even Nobel Prize winners are subject to these biases. These are behavioral biases. Look, you won't invest the same throughout your life because your priorities and your risks will change. So your investment strategy will also change. The trick is that time is your greatest asset when you are young. When you're older, you're just not trying to grow money as much necessarily. You're trying to protect it. You're about to retire. It's not about age so much. It's about what the wealth stage in life is that you're at. So you're either in growth accumulation or you're in preservation mode, right? So at some point you will mature into wealth preservation being more important than wealth growth or accumulation. So how do you decide what percentage of your portfolio to put into wealth preservation and what percentage of your portfolio to allocate to wealth growth? Now, I personally love the 110 rule. It's great. Like this 110 rule, now different people teach it differently. Take the 110, subtract your age. So if you're looking at this and you're 30 years old, then 110 minus 30 is 80. If you're 40 years old, 110 minus 40 is 70, right? So that's how much that you put in percent to allocate to equities or stocks. Now, these are slices of ownership in publicly traded companies, so we can actually buy and sell them. And they typically have great long-run growth performance. That's in the long run. But they can be subject to wild swings up and down. Now, the other 20%, typically that's for bonds or fixed income securities or other things as well. Like these usually have lower risk, and so they can smooth the ride. Now, if you have more of an appetite for risk, you can increase the percent that you are in stocks. That's what I personally do. If you're more averse to risk, so you dislike risk, then you can reduce your exposure to stocks. There's nothing hard and fast here. Some people allocate to other types of assets like real estate. I do. Commodities like precious metals, gold and silver, I've played with those. Or other things like oil, soybeans, you name it. Even cryptocurrencies, which I do too, like Bitcoin, Ethereum, or pure cash. I've got some of that too. Some go international also. Portfolio Visualizer is one great tool for playing around with this, right? First of all, you're going to have to create an account. Once you create an account, you can do back testing and all of this stuff here. You can plug in different portfolios. I love the 100% portfolio, but I'm extremely risk tolerant, and I find myself that I'm very, very safe in terms of other areas of my life. So I need to increase the risk in my portfolio because I have very low risk in my job. I'm a tenured university professor, so that means it's like a job for life, right? So because of that, and because of my asset base I'm coming in at this point with, I'm willing to basically put 100% in. Now, this is not for the faint of heart. This is not a recommendation, but I know, okay, I feel confident in the long run I'll probably do better over a very long period, but in the short run there'll be huge, massive drawdowns. So the actual amount, the biggest amount I'll come down with, a lot of risk. But you can play with things in different percentages like bonds, real estate, you can knock yourself out. But let's keep it simple, right? For those that don't want to play with portfolio visualizers, let's keep it simple. There's only so much you could invest, but for most people, right? There's honestly so many things. Like there's a big table and you've got everything. There's like, you've got your silver, you have like, let's say if you're eating at a dining table, right? Like your starters. Like imagine a big smorgasbord of like all kinds of food, right? Like a king's medieval court, right? And we're seeing all these food. You could choose this, and there's wines, and there's desserts, and there's every type there. That's like the financial markets. There's everything you can invest in, but you probably only need one. Right? You heard that right. Maybe two, one or two. I think that most people would probably be best off just investing in a target date retirement account that does all the work for you. So you'd specify the year that you may think, like, this is the year I'd like to retire. Maybe it's like, I don't know, 2050, let's say. And you say, okay, that's fine. I'm going to invest in a 2050 retirement account. You're going to buy that fund automatically. Now, what do I actually do? So I was interested in equities and bond, the actual split of Jack Bogle, who invented the index fund, right? So I tell my senior undergraduate students, by the way, guys, he invented this when he was in college in your year, so no pressure, right? So he invented this, right, when he was in college, but now it's the biggest in the world. So like, what I look at his split. He's got two things. He's got VTSAX for the broad market index, and he's got VBTLX for bonds. You can get equivalents in BlackRock and iShares, Fidelity. There's all kinds of equivalents. You don't have to do this. This is just what I do. So most large US companies are in the VTSAX. They're exposed internationally. So you might be asking, well, Michael, you don't have any international exposure. Okay, fine, you want to do that, that's okay. But you already have that diversification. Coca-Cola, like Tesla, Microsoft, Amazon, Facebook, they all have international exposure. What happens in other countries will affect them. But because I'm extremely risk tolerant, and because of my active purchases of real estate rental properties, businesses I founded and run, other interests like stable job, lots of savings at this point. When it comes to asset allocation, I have been more or less 100%. I do own some of Warren Buffett's Berkshire Hathaway shares, but that's just so I can attend his annual meetings. But I am pretty much 100%. Like, it's negligible, the amount that I hold in everything. It's 99 point something percent, right? It's 100% in equities for the best part of a decade now. I've taken the ups and the downs, and it has roared, right? It has roared. Yes, there were massive downs, but as long as you don't jump off the roller coaster, right? Sell when it's low. That's the worst thing. You're getting a terrible price. Then it goes straight back up. So you need to go further. How comfortable with risk are you? I'm extremely comfortable, but I'm not the average person. How comfortable are you with risk sleeping at night, especially when the market is volatile? It could be flat like 2022, right? It was very, very boring and annoying and frustrating. This matters just as much as allocation. It's whatever you're happy with, choose it and stick with it. Yes, there's concentration risk, and your portfolio could get heavy in one thing, like me with equities, but without even realizing it and reallocating it. But I don't want to have to spend time. I don't want to face costs of selling, including taxes, if it's outside it's not in a tax advantaged account. I don't have to worry about it. I just don't jump off the roller coaster. I don't care what's happening to the market. If it's down, I say, great, it's good to buy, it's cheap. If you heard it in any other thing, if you were hearing about clothes and the price of clothes went down, you'd be like, this is great, I get a sale. It's like going to the outlets, right? When the market is down, I buy. And if it's up, I'm happy because my wealth is up. I just don't manually invest for the most part. I turn on autopilot and I tune out. I stick wax in my ear. This is actually what Odysseus did for those that are classics, right? In the Odyssey, Homer's Odyssey. I stick wax in my ear. I put blinds over my eyes. I don't know what's happening. But this took me education and time to understand and to avoid the idea called time inconsistency or the smoker's problem, right? Like, I'm going to give up smoking tomorrow. These are behavioral biases. Tomorrow comes, you still smoke. It's you are your own worst enemy. Also, instant gratification. I have to have it right now. I have delayed gratification, right? I'm okay waiting for the future. Now, Morningstar's Mind the Gap annually updates a study that shows how people, you and I, underperform the funds they invest in. Sounds strange. How could you underperform the fund that you invest in? Because they sell when the fund is low and they buy when it goes up. So you're buying at a higher price and you're selling at a lower price. You're going to lose money. And we are our own worst enemy, as I said. So risk tolerance matters. It's the biggest thing. Like, build a strategy you'll stick with and not sell when it gets bumpy. Do something you're comfortable with, whatever that is. It's better than doing nothing, but stick with it. If you start switching strategies, that's how you lose money. If you took nothing away from this, just don't switch. Stick with something, stay with it. Don't change it. If you change it, it's almost guaranteed to lose money, or to lose money relative to what you could have done. There are flukes, but it's better sticking with it. Speaking more on concentration risk, I should say that it's important to get some independence and not to be too high in any one area. Now, this could be like a single investment, like if you've got everything in one stock, like you hold just Tesla, for instance, or you hold just Coca-Cola, or you hold just Amazon, or you hold just whatever, IBM. Like, that's great, but you're basically there. If there's Mark Zuckerberg of Facebook, like if he leaves the company, what happens, right? You've only got one stock. It's important, right, to go beyond that. Like, maybe you only have tech stocks. That's all you know, like one sector. Well, maybe there's other sectors that actually provide more stability. Like, it could be in the utilities sector, or it could be in other areas as well. You know, in retail, communications, etc. So there's plenty of other sectors. Maybe you have energy, like oil and gas, things like that are going up when tech is going down, and vice versa. Maybe it's that you have all your risk in one country, all your risk in one asset. I mean, it's just stocks. You've got no real estate, no cash, nothing else, or more. There's plenty of it. Now, suppose that you are working for a company and your company has given you a thing called company stock options. This is another thing of concentration risk. Ask, is this becoming too large a percentage of your overall portfolio? Like, do you truly believe in your company's long-term prospects? Now, you may want to de-risk by selling a bit and transferring into other investments that make more sense for you. Understand your own risk and how close to retirement you are and your risk appetite. This will determine how your portfolio looks and what percentages you choose. This helps you build a sustainable portfolio and ensures that you're fine no matter what happens.